Welcome to the Amplify to Seven Figures podcast, where we look inside the mind of seven-figure entrepreneurs to see how they amplify their business and amplify their life. Let's welcome today's guest. Welcome to the Amplify to Seven Figures podcast. Today's guest has helped thousands of real estate investors, business owners, and entrepreneurs become fundable. He developed a process that could optimize a consumer's borrowing behavior and improve borrowers' fundability. He founded getfundable.com to deliver this revolutionary technology to borrowers nationwide and help them access the capital they need to fulfill their financial dreams. Please welcome to the show, Merrill Chandler. How are you doing, Merrill?
Thank you very much, Paul. It's awesome to be here.
Yeah, really excited to jump straight in. So now, the first thing some people will be asking if you listen to this is fundability. Right. So we hear a lot about things like credit score and things like that, but fundability, maybe not everyone's heard of. What exactly is fundability?
Great question. So fundability is the ability to receive funds from a lender. Now, one of the biggest myths that exist in all markets that use a credit score is that your credit score drives your approvals. Not true. Credit scores do not drive approvals. Credit scores are almost used as a shiny object to keep us distracted from what they're actually measuring. So fundability and credit scores are completely opposite. And fundability is based on FICO's algorithm that reviews 40 borrower behaviors over the last 24 months in increments of 3, 6, 12, and 24 months. So what they're doing is they go, oh yeah, I have an 820 credit score. But over here, they're like, okay, what are these 40 behaviors? And they're all measurable. They're all found from data that are on your credit profiles and how you pay your credit payments, how you engage new loans, how you look for credit. So that's what they're measuring. So credit score is nice, and all the time your listeners, they compete with their spouses and partners like, hey, they're racing to 850 or whatever, right? But they're chasing the wrong goal. What we want to do is we want to find out how fundable we are. So that's what fundability is the measurements required to get us approved by lenders.
And just for our international listeners, including myself, what is FICO exactly?
Oh, exactly. So in 128 countries, FICO drives the risk assessment for lenders. So like FICO World is a conclave. It's a gathering of all people who use FICO software to do this. And I've been to the last 3, and there are 128 countries, and everybody's speaking every possible language out there. If you haven't heard of FICO in your country, FICO is what's happening behind the scenes to evaluate. So a lender, when you go from whether you're Argentina or Croatia or the UK, wherever you are, if you're looking for money from a lender, a bona fide lender, then they're using this FICO software to evaluate you.
That's interesting. You know, first I didn't even know that. So it's not so much a wholesaler, but it's almost like the wholesaler behind the underwriter, right? In a way that the guy who's just, well, not the guy. It's not one guy just going, yeah, no.
It's a little rat on a machine. Yeah,
the little system behind the whole machine.
Yes. So FICO, what FICO does is FICO is used as a component. Lenders use software, as I've been saying. Fundability is lenders use software to evaluate these 40 behaviors. FICO is used to determine risk. So how much should the approval be? How much should the interest rate be? How long the terms are acceptable? So it's in charge of rate, interest rate, and terms, and the amount loaned, but not the approval. The approval is with the lender. So it's like a plug and play, right? It's the nitrous to your 10-second car, right? Race car, so that they can maximize, they can lower risk when lending to you.
Right. Okay, cool. Makes sense. So before we go any further into the how it works or how to get the most out of it, let's talk about the why. Let's talk about, especially from an entrepreneurial perspective, like, so how can having access to business credit for an entrepreneur, how can that really help them grow?
Yes. So imagine your business, and it doesn't matter if you're in real estate internationally, or you're a foreign investor in any other country, right? Imagine having 500,000, $1 million in credit lines, like write a check and do a deal so you can take down a property and then get long-term financing. If you're borrowing as a real estate investor in the United States, you're going to get a conventional mortgage. But conventional mortgages take too long. So entrepreneurs use these credit lines in order to get the property, take over the property, rehab the property, and then either hold it for a rental or an Airbnb or the like, or they will sell the property and what they call a fix and flip, right? And so credit lines, if you're not in real estate, if you're in manufacturing, if you're in an online service, like you have an Amazon store or the like, retail stores, you can buy inventory and keep that balance on your on a credit line. And that credit line actually is right now is prime in the United States. It's prime plus 0.5% to 2%. So you might get something in the neighborhood of 3.5 to 4.5% interest rate to carry any kind of inventory, carry any kind of supplies you might need to grow your business. Also, if you're scaling, the greatest impediment in all businesses that are destined or on the path for a 7-figure or higher, that the greatest impediment to growth is capitalization, right? If you need to build software to automate, you got to pay those programmers today, not after you start selling products tomorrow, right? And so credit lines give you a chance to scale now and then be able to sell your new level of product, services, et cetera, after the fact.
So, and just to add to that point, from a course creator perspective, we work with a lot of course creators, and for example, especially the way Facebook ads are going right now, you see a lot of businesses having to go in the hole on the front end, right, for 30 days
Absolutely.
before you're going to get it out the back. So if you're like, hey, we know that last month we spent this much, but then at the back end we made this much, but then you've got this 30-day lag there, and you want to go and spend another $300,000-$400,000 on ads, then you're
Correct.
saying with these processes that you can go ahead and get that funding to accelerate the growth.
Absolutely. In fact, especially, and here's the thing, and there's what's called automatic underwriting versus manual underwriting, and it's catching on more and more in the European countries, in the Far East. Anybody who's using FICO, any of those countries tend to use automatic underwriting, which means it's software driven. The approval is software driven. Other banks you walk in there and you show them your pay stubs, you show them your asset list, and that's called manual underwriting. Well, automatic underwriting is becoming more and more prevalent in all developed countries, right? And so what happens is this automatic underwriting uses those 40 borrower behaviors, so you don't necessarily have to prove your income. They're looking at your checking account, business checking account. You don't have to prove your assets are meaningless if they have enough data points to measure that you have the means to pay it back. So let's say that you have done, if you're running they measure your checking account and they see ad spend for 50,000, right? And then 60,000 and 70,000. The payoffs are within 30 to 90 days, and they see the dollars come back in, but you're growing so slowly. They will evaluate, the software evaluates these trends, and you might not have to give a business plan to these $100,000, $200,000, $500,000 credit lines. They may literally go, oh, this is your slope trajectory, so we'll give you $100,000. Let's see how you do. And then they'll raise that credit line $100,000, and then you're able to invest in your business and got to be smart because it's other people's money. But if you're using that same trajectory, then the slope improves and you have higher yields, which makes you an extremely valuable customer to them, and they want to give you more money.
So, and if let's say you get in a credit line of $100,000, and we'll use Facebook ads as the example because a lot of people listening will be doing things like
Sure.
that. So let's say you're like, okay, cool, we're going to scale from $100 to $200,000, but we know the payout is not going to be for another 60 days, so we need that credit line. Now, what kind of interest would someone pay on something like that? So if you knew you were going to pay that back in 30 days, would it actually cost you anything to take that credit line, or not?
Yes. Great question. So the credit lines are different than credit cards. Credit cards give you a 30-day grace period, right?
Yeah.
So you charge it up, and then you got 20 days to pay it off, 30 days interest free, and then if you pay it to zero, there's no interest. Credit lines generally charge you the moment you deploy the funds. The interesting thing about if people are using the other strategy for this is that they don't go as high. It's more difficult to get $100,000 or $200,000 credit card, right? But some people have aggregated credit cards. Let's say you have 2 or 3. You want to use business credit cards, not personal credit cards, because that will just crush your personal profile. You don't want that kind of traffic on personal. You want those on business, right? Especially business doesn't report to personal profiles, and so it's like you're using all this money over here, but you just look like a tiny little money machine over on your personal side, right? But if we're using these big lines, then you're going to be charged from the second you deploy the capital until you pay it off. But remember, this is 3.5%, 4.5%, maybe 5% interest. So what's your ROI on a Facebook ad, and that you're doing 50 grand, 100 grand, 200 grand worth of ads, right? So it's a perfect instrument because it's designed to be 1 month, 2 months, 3 months, up to 6 month deployed. They don't like you to write a $100,000 check, and you can use it like a credit card as well. You just put in your 16-digit number and then Facebook, and they'll hit the account, right? But they'd rather have it what's called churn. They'd rather have money in being paid off from a previous one, and it just cycles through so that they can see that there's always what we call traffic. The more traffic you have, the more churn you have in the account, the more valuable you are as a borrower, and you're off to the races.
That's given me some education on that as well, because I haven't really got into funding much at the moment. So you said this 40 points. Now we'd have a very long podcast if we went through all 40 points. However, is the one of two of those points that, like, if you're a business that you want to get that credit line right up in a short space of time, how can you move the needle the fastest?
Okay, so the gateway to fundability is your identity. Now, this blows people's minds, and then when they pull a credit profile, then they get pissed off. So we're going to cover that real quick. So the gateway is your identity, because in automatic underwriting, which they trust these algorithms, lenders trust these algorithms, because it's so focused on the minute details of all the data points. So if my name is Merrill Ray Chandler, but before I knew what I was doing, I filed applications under Merrill Chandler, Merrill R Chandler, Merrill Ray Chandler. I think I even did one M Ray Chandler. And so all of a sudden, when it comes to automatic underwriting and algorithms looking at this data, these are 4 different borrowers. We're not showing we're not showing at the point of sale. We're not showing our driver's license or our national identity card. We're literally telling them, check, this is who I am, and they have to parse out which Merrill Chandler am I working with, and which of these data points are actually true for this borrower. Which of these identities is paying me back, not which human being is paying me back. And so then they're going out, then they ping all the databases, the credit bureaus, in fact, the largest Experian is owned by a British conglomerate. The which is a massive data collection throughout all of Europe, right? They own Experian, which is one of the top three what I call the unholy trinity of credit reporting in the United States. And so they have access to all this data. They're pinging these databases with your application. And if your data doesn't match up with the databases, because they're going to trust what lenders say about you before they trust what you say about you. So the process we go through is we clean up all of these databases, right? Because they're reportable, you can change what's being reported, all legitimate, legal, ethical, moral, and non-fattening. So when you go through this process, you are able to become one single identity in this whole mess of identities that you've probably created because you file different ways. What's on your lease, it may be a different version of your name than what's on your car purchase, and your car purchase is different than your last credit card. And so who is this person? If we clean that up, that's one of the 40, and it's what I call the gateway to funding, because they got to know who they're lending to before you can get approved. And if it's confusing, it's a lower approval. It can get you a denial straight out of the gate.
Wow. Yeah. That makes me think when we go for our new mortgage on our next house as well. We may be having a conversation at that point.
Yeah.
So something that is a little bit of a curveball, but I'm just intrigued from your perspective. Now, I've seen in China, they're going down this like social credit score.
Social, yep.
Like generally, what's your thoughts on that? Do you think that's actually going to turn into something that's going to come across the world, or do you think it's just the way? Obviously, you have to be careful about what you say. I don't want you to get arrested by China.
Yeah, right. No, I actually believe that is the degree to right now in the United States. They're already using insurance companies and all types and alternative lenders are using non-FICO driven funding criteria. It could be, did you know that there's a correlation between your battery and how well you pay your bills on your cell phone? So no joke, there is a correlation. That is a non-traditional metric that if you are careless enough to let your thing get down to 10% or 20%, it's also going to indicate you are a poor risk, because you're going to let more important things go by the wayside as well, because it's about our the way we are as human beings, not just our attitudes about money. It's borrower behaviors. And so that we actually have 150 borrower behaviors that are bona fide straight out of FICO, but they're only using 40 of them now. So we optimize our clients for all 150, just because we don't know what's going to change when and where, right? So I believe the social evaluation is going to take hold more depending on the political climate of the social climate of every single country. Some are going to be like, oh, hell no, right? That is not a thing. Whereas others are going to be fast and early adopters, because they're like, yeah, we want to know how well you treat your servers at the restaurant, right? We want to know what kind of a human being you are. So we're about social is probably that's the typical term that's used, but I believe it's more the quality of human being that you are over just your social rating, because it's how do you treat other human beings, because you're going to treat money just like you treat everything else, right?
Wow.
So
it's like Black Mirror.
Okay, but I love that show.
Yeah.
And that thing, because it's going to create, it's basically going to divide us as countries and as people, because there is going to be those people who go off the grid, right?
Yeah.
They're like, I'm not going to be a part of this. And others are going to be driven by that score, just like in that episode of Black Mirror. And all of a sudden, right now, it's already bad enough. We take our financial cues from a 3-digit number if FICO is in your country, right? We're already evaluating our credit worthiness based on this 3-digit score. And I got to tell you, Paul, I just did a podcast of my own that talks about fundability versus credit worthiness. Credit worthiness is where if we get approved, our ego selves goes, you know what? I earned that. It's mine. And we can be more careless with money because we earned it and it's ours to use. Now, no lender on the planet believes that's money is yours to use. You're borrowing it, but we take it over, right? And so we get a little haphazard or a little careless about how because we're worthy of it. Fundability changes that entire dynamic. It's, are you fundable? Do you hit the borrower behaviors that a lender is going to lend to? So all of a sudden we change our behaviors. We don't make it a head game that I have an 850 credit score. If you're in America, there's a ton of people who have an 800 plus credit score, which is like the finest scores you can have. And they're false. They're based on, because people think an 800 score should get you money. It doesn't. I have a whole bunch of clients who have higher than 800 scores, but they can't get a dime because the score doesn't approve them. Their behaviors do, but we've been led to believe, again, down this little rabbit hole with so that's kind of, I love the direction where this conversation's gone, because
I didn't know where that was going to go either, but
because this is a thing, and entrepreneurs, business builders, we got to know, not just for ourselves, we also got to know for our companies. Here's another one for you. In the United States, and if it's available here, guaranteed it's available worldwide, you can purchase a service from Equifax. It's called the Benefit IQ. Yeah, from Equifax. Google it. And what they do is they will take certain data from your employees, and they will tell you what the credit scores are of all the employees without knowing their names, without disclosing to you their names. They know the names of the employees, but they can give you an entire rating of your employee base of how well they're performing when it comes to their financial commitments.
Wow.
Huge operational intel, but also kind of creepy, right?
Yeah.
So it's a mixed bag for me, because if I had that knowledge, I use that to show to employers how that one of the biggest time hogs is stressing about money. How do we educate our borrowers? Because that's my mission in the world. Educating borrowers about all this stuff, what's actionable for them, what can they do to be better and more fundable. And so this is exactly what we present to benefits package companies, is how do you improve the quality of the work life of your team members, because they feel better and more knowledgeable and more in control of their financial lives.
And is that something that you mentioned about, like in 128 countries? So we've got we don't employ, but we have freelancers that work with us, a lot, just because it makes more sense. But yeah, we've got one in Nigeria, one in the Philippines. So is that with that like Equifax thing, is that something you could still see across the board? Or
I have not asked that question because it hasn't been available to me, but I would be very interested, because it would be whether or not Equifax has collected that data. I don't know if it's strictly for the United States. I don't know if it's English speaking countries. I don't know what the reach that Equifax has for this particular service. I do know they have gobs of data, and they merge data with, they sell each other data. Europeans and the Far East will send everybody the data, and it's just data is the gold rush, right? Data is the gold rush,
the modern day gold rush, and everyone's out there with the pickaxes. Right. Going, look, I found some more.
We found more data, and so they're pulling it from phones. They're pulling it from your Facebook accounts. They're pulling it from everywhere to find out. Like, for example, insurance actuaries will review your Facebook. If you've got skydiving Facebook posts, you're going to be a high risk you're going to be a high risk life insurance or accident insurance individual.
I use that as a filter on one of my ads the other week. You know, you can get those like Facebook. I hope they don't look at that and think that I'm high risk now.
Now you're high risk. Yeah. See what I'm, but this is, and now there's two views of this. If you want to play the game, then you have to be masterful at playing the game. Because if to use the basketball metaphor, we can't be like, a high school basketball player when we're playing against pro ballers, at the national NBA level. So we have to up our game if we're going to play it. Or we got to get out of the game, and there are voices in every country, the financial voices that say debt-free, get out of the system, go off the grid. I'm not that guy, but I used to be that guy when in my 20s, but now for whatever reason, I've become a masterful player of the game. And so I have opportunities I'm a perfect borrower. I'm a perfect bank customer. And so they love to lend to me. So there you go.
I like it. So one of the things that we look at on this podcast is the legacy, the thing that you want to leave to the world. So what do you want to be remembered for when you die, Merrill?
I want to be the guy that raised that was able to educate the masses about this game. We've been kept in the dark for so long. I want to be known for having shifted the dynamic between adversaries, borrower and lender, to partnerships. I want to be the guy who said that we now partner, that where every bank, every lender in the world literally saying we partner with our borrowers, we partner with our lenders so that it's a win-win for both. For centuries, since the medieval ages, when paper script changed gold, right, and silver coins, there's been an adversarial relationship, us versus them from both perspectives. I'm going to be the guy that transforms into true, like, every framework is filtered through partnership.
I love that. So taking it from them being on the opposite side of the table to being on the same side of the table.
Exactly. Well said.
I like it. So what is one quick win that people can use to amplify their business today?
If you want money to expand, grow, buy ads, etc., that it would be get fundable. So you've got to get fundable. And I have a book on it. I have a boot camp on it. You have to know what lenders are looking at. We walk in and fill out an application and we have no clue whatsoever what they're looking at. You don't know what bureau they're UK has 2 bureaus, right? Canada has 2 bureaus instead of 3, but it's the same 3. It's the same pool of 3 bureaus. You don't even know what bureau they're pulling to approve you, right? Much less, this is scary, much less which version of the scoring software they're using. And there could be a 50 to 70 point difference depending on the software, not your data, the software that's filtering it. So if you don't know these things, find out.
Where can people go and get that book?
Getfundablebook.com, getfundablebook.com, and I have a 16-hour boot camp for $100, and you can go to getfundablebootcamp.com. So one is the principles, the book are the principles, and the strategies to implement are in, and it's good. We've had folks from the UK, from Europe, and from Canada all attend and get tons of good value out of it, even though some of the banking issues may be different. The principles are the same. Human behavior regarding their finances is ubiquitous around the world. So getfundablebootcamp.com and getfundablebook.com. The other thing is, if they would like, you put this in your show notes, if they would like the ultimate fundability checklist, it's free. Just tell us where to send it. It's getfundablechecklist.com, and you can go get, there's 70 things that need to be done for ultimate fundability.
I love that, and you've also spent quite a bit of money on domains. I like.
Yeah, right.
I love it. So go ahead, go to getfundablechecklist.com or getfundablebootcamp.com. And any of the other places as well. Again, we'll put those in the show notes. Merrill, it's been fantastic having you on the show.
Been wonderful. Thank you, Paul.
You have been listening to the Amplify to Seven Figures podcast with me, Paul Ace, and my amazing guest, Merrill Chandler. Remember, amplify your business and amplify your life. Bye for now. Thanks for listening to the Amplify to Seven Figures podcast. To access the show notes, episodes, and this month's giveaway, head over to www.amplifyto7figures.com. Remember, amplify your business, amplify your life.